Well, it broke out, and here's two simple methods of determining, well, where might you go? If you look at an arithmetic chart, which is what people punch up on their screen, dollar on the side, dollars on the side, but not logarithmic or ratio scale. You see this $4 to 50, $4 to 50. You broke out, but when you measure the thickness of that perfect rectangle and do the orthodox technical analysis thing, you got a range, call it $45, $5 to 50. We call it 0 to 50 if you want. Add 45 or $50 to $50, and that's your swing objective, the thickness of the prior range. Well, you'll remember back a few weeks ago, we had a struggle going on for a week or so in the low to mid 90s. In other words, there were a lot of sellers there saying, hey, we've met the arithmetic swing objective. I'm getting out. Okay. And then all of a sudden, boom, you got 121. So it's evident now, okay, getting to 121 means the old arithmetic ratio or arithmetic swing objective was invalid. Okay. But when you put silver on a logarithmic scale chart, a ratio, and you measure the dimension of that 50 half-century range, from the bottom of that range to the top of that range was a 10-fold gain. Mm-hmm. If you bought silver for $4 or $5 and it went to 50, $4 or $5 went to 50. Wow. 10-fold gain, back and forth. If silver matched the 1980 high, I haven't done the math. I bet it's like $400 or $500 just to match 1980. So talk about, was that the top? Even using simplistic methods, no. By going way beyond the arithmetic goal, it's saying, hey, maybe I'm going to the ratio scale goal. Well up in the 300, 400, 500 range. That's what we think is about to happen, and we think this is simply a midpoint gut kick, not a top.
According to Michael Oliver, silver's sell-off didn't break any long-term momentum structures. Using ratio scale analysis, he projects silver could reach $400 to $500. The move to $121 invalidated the arithmetic target of $95, confirming higher logarithmic objectives. Miners remain historically undervalued at just 8% relative to gold versus the 17 to 18% floor that held for decades. Thanks for watching. Give a thumbs up and subscribe to Fine Metals for the latest insights.
Now, originally, back February 2016, we said gold's turning up and silver, that was the bottom for silver. Okay, fine. But since then, we gave a couple other entry points that we considered good investment grade entry points based on momentum breakouts of silver and based on its spread relationship to gold. In other words, when you plot silver month to month versus the price of gold, and you plot that chart, and what we do is we divide silver into gold, express it as a percent. So early last year, for example, silver was 1% of gold. Now it's up toward 2. Okay, nice move. But historically, if you go back a long way and plot that chart month by month, you'll see that for 10 years, there was a ceiling on that relationship at a very low level. And we cleared that in November. And when we cleared that and silver broke out versus gold, in other words, no longer the dog, I'm going to lead now. Okay, that's what silver said. That was $50.
Yeah.
And boom. Okay, what happened since? Okay, so if your entry level was back in June of last year, where we had our first buy at $34.79, or at that $50 level, yeah, you gave back some profits, but you didn't get anywhere close to your average entry price. So again, point of entry is very important, and it probably affects the way a lot of people are thinking about this right now. When you look at short-term stuff, which is basically what that was, in other words, when we broke down, really it was one day. Think about it. It was Friday, and then we had a minor follow-through today, but basically one day. When you look at long-term trend factors, technical stuff we look at, momentum, it was merely a storm without breaking anything. In other words, there's no structure it broke, no trend. It didn't even jeopardize. Frankly, there are no real developed momentum, what we call momentum trend structures, that are anywhere nearby. And normally, and I'd say normally almost 90% of the time, whenever a market makes a top of significance and lasting, or a bottom, you'll be able to look at a momentum chart, like a long-term momentum chart, where you measure price, let's say, oscillated in relation to a 3-year average, or oscillated in relation to a 3-quarter average, or something fairly long-term. You'll see structure on the momentum chart that says, oh gosh, there's a line, I better not break. And almost always, when a top is made or a bottom is made, you'll find that the breakage occurs not very far in time or price from the high or the low. This occurred, for example, 2011. We peaked in was September, I think it was. We turned major bearish in December and then in January 2012. Okay, a couple of months off the high, a couple $100. And in fact, it labored for another year before it really fell apart. That's gold I'm talking about. Mm-hmm. And but the structure was, if you looked at the momentum chart, you say, good grief, any idiot could draw that line. But it wasn't evident on a price chart, but it was a momentum. Same with the bottom. 2015, after the 50% bear market, gold bottomed. And when you looked at the annual momentum chart, not the gold price chart, it kept just staircasing down a little bit. It slowed up. But you looked at the momentum chart, there was a chart pattern there that you said, good grief, look at that ceiling. It's 3 years wide. You keep going the same level. When you broke through, it was February 2016, mere $90 off the price low and 2 months after the price low. Whereas when we look at the charts now, gold or silver, and run any long-term study, there's no nearby momentum trend structure to even break. Mm. And so we think it is merely a violent jiggle in the middle, and I suspect it won't take a long time to recoup from it, meaning you might be in new highs next month or so. I think we favor the miners over gold, and there's a level, though, that we haven't broken through yet. What we do is we measure the XAU index, which is the Philadelphia Gold and Silver Index, but it's miners, okay? It goes back to the 1980s, so you got some history on it. We plot it in its relationship to an ounce of gold. And if you do, and you go back to look at the 1980s, 1990s, 2000, until 2008, for several decades, if you divided XAU into an ounce of gold, you'd end up on average, above and below, a range of 25%. Mm-hmm. It reached up to 35% at one time, and its lows during this multi-decade period, when you plot the charts like a box, okay? We're in the 17, 18% level. You broke through that in late 2008, and you collapsed that spread, meaning the value of the miners to what they get out of the ground, okay, to 4%. Now think about that. Something that had lived in an average price versus the thing it gets out of the ground, gold or silver. It went to 4%. I mean, we don't need miners. We need gold, silver. We don't need the miners, right? Okay. That chart is screaming at you, hey, you think I'm going to go to zero? And so since 2014, you can plot a range on that same relative performance chart. Beautiful little box. And it's like from 5% up to 8 plus, 5% up to 8 plus, 5% up to 8 plus again, intra-month, last month. Right now it's back below 8%. But if you get much above the top of that range, and we think this third assault on the upper end is probably the one that's going to break out. So it didn't break out last month. But you get up above the top of that little box. Again, visualize that as a chart. When you break out above that beautiful technical range, there's nothing to stop you, technically speaking, in terms of the value of the miners to the metal they get out of the ground, until you get up to 17 or 18%, which is to say, to go bump the bottom of the floor that had existed for decades. So you go from, boom, you could double the miner's value relative to gold. And I strongly suspect that's about to occur and will show itself this year. And probably the breakout I'm expecting next month or so of that spread. And when those spreads break out, like the silver did back in the November close, look what happened to net price over the next 2 months. It went berserk. Expect the same from the miners. And there's 4 miners coming up with silver miners coming up in the first 2 weeks of February with earnings for the biggies. that report will be based on what? Fourth quarter, right? Okay. Go back and look at a silver chart. Where was it during the last quarter of the year? So, that's what they get out of the ground, therefore their profits are, et cetera. Average $50, okay? Somewhere either side of 50. Right now, so far in the first month, our average price is, well over 100 average price now I'm talking. And if we stabilize here and then sort of work our way back up so that February and March we're back up toward 100, 120 again, then your average price for the new quarter is going to be about 100. Okay, double what it was before. So the guys who look at earnings and say, wow, this miner's making a lot of money at $50 last year. Golly gee, that's really good profit. Because remember before when we were at 50 in 2011 and 1980, you collapsed from it quickly. You didn't stay there. So you never got an average price up there. This time they had an average price in the fourth quarter of $50 or so. Wow, so the earnings have to look real good. Imagine what they look like if this quarter has an average price either side of 100.
Yeah.
So if you're looking at that as a factor, whether you should tell your clients to buy silver miners or gold miners, you don't have any excuse now not to say yes, based even on the fourth quarter earnings, much less what looks like could be evolving for the first quarter. In December of 2015, when gold made its low at $1,050, the dollar index was about 1 point higher than it is right now. So for 15 years, it's been above there and below that level like this. And right now we're trading about where we were in December 2015 when gold has since quintupled. Okay, so to correlate gold's moves with the dollar, not very good. Sometimes you'll get short-term coincident moves, inverse moves. But I think basically it's the big move in the dollar that will likely help, not be essential, but help gold in this process going forward. And I think the dollar slipped off that edge at last month's close. So at this point, we're fully negative on the dollar. I don't expect it to crash, but I could see a significant down move. Now, the other factor, you mentioned Brazil. Brazil reflects the commodity complex. EWZ is Brazilian ETF in US dollars. That's why I ran that report. The Bloomberg Commodity Index is cheap in relation to its own historical prices. It's a well-balanced index of energy, grains, base metals. It's a good index to watch. Last October, Bloomberg was coming up through 106 on price. We said, that's it, breakout. It's resuming. It's a second major up leg. The first leg was a 2020 to 2022. This one, from a higher low level, is starting the second leg. It's since gone up over 120. Right now it's having a pullback today. But we think it's now in a new major bull leg. And when we look across the spectrum at the subcomponents, like the grains, wheat also just broke out last month on quarterly momentum. Crude oil just broke out on quarterly momentum. So a lot of its components are saying, yeah, me too. Okay. Well, this impacts underpriced, commodity-based economies, Brazil being an ideal one. And sure enough, when we ran the study of Brazil's long-term momentum, it was like an overlay of the Bloomberg. Back in the 2020 to 2022 move, which, by the way, peaked 3 weeks after that war began in Ukraine. So that didn't take it up. That basically topped the commodity boom. Oil was a leader. It was doing better than most other commodities. This time around, it's a laggard. In fact, it just came out of the sewer hole, a month or so ago. It was $55. Now we're trading about 62, 63. So when you look at it historically, just itself, so what's $60 for crude? Well, you go back in time, a decade or so, you say, well, monetary inflation, degradation in the buying power of the dollar, has gone up 80%. So et cetera, in reverse. Oil hasn't gone up to reflect that, and oil in relation to its own highs is less than half the price of its prior two highs, 140, 130. So it's cheap. Okay, that's one argument. The other is we had a momentum technical breakout at the end of last month. getting above 63 on a close, end of the month. And that broke, if you look at a price chart of oil, WTI crude, and go back 5-6 years, you won't quite see why that was important. You'll see, yeah, nice uptick, but no big deal. But when you run the momentum charts that we have, you broke a very clear, massive, multi-year structure that had defined all the rally highs, capped them off, and you went poof, punched through it, and you broke out last month. So there's no excuse for that. There's no need. You don't need a headline.